Does it work? Yes. It's like with my students, I'm very, very happy when it's very difficult to be able to speak, because that means there's good interactions. So we are bombarding you with lectures all day, but it's just because some are shorter and some are bigger. We want you to be able to discuss based on everything that you hear and interact. And I hope that until now it seems to have worked. I am so happy and proud to introduce Wojciech Kopczuk here for Columbia University to have to give the keynote, or basically the Skatteforsk lecture 2025. That's a very rare honor. It's an annual institution since we started the center, so this is the third in a row. We had Gabriel Sockmund and Nadine Riedel, and now it's Wojciech who's here. And we have been working together for, I would say, 20 years, but maybe not. Close. So we had a PhD course now, and there we had Wojciech and also Ron Davis, both who are or have been like editors. We gave them an introduction on how to give comments to others, and how to be a discussant, just soft skills. And one of the main things that Ron said, the first thing is, well, don't be an ass, or don't be a jerk, like be nice. So you can be nice, but you can also be critical. So whatever, like Wojciech tells a story how we met first time. I was giving comments on an IFPF conference. I can't remember this, but apparently I was very critical. But it means that he has been like for 20 years struggling to make me happy. So it can also be a very good strategy to secure co-authors for a long time. Without further ado, I give you the floor for the keynote. Thank you.
Thank you very much. Yeah, so she really hated that paper. And that was I know when it was. It was in 2003. For that paper that you hated. Anyway, all right, so what I'm going to do today, so I got an hour, each of you got 20 minutes. So basically, I'll present a paper, but I'll say a little bit more about why I'm interested in it. Like there will be a bit of an introduction. Then I'll talk about what exactly we are doing in this project. And if I have time, which I probably won't, maybe I'll show some additional things at the very end. You see the title. It's a paper about businesses or organizational forms of businesses for a very particular group of individuals, for doctors, and specifically for doctors in Canada. I'll try to convince you that doctors in Canada are interesting for some reasons, but like the truth is, I shouldn't say it out loud, but I will. I don't really care about specifically doctors in Canada. They are just an example of something that we think is interesting. And I should say it's joint work with two other people, with Terry Moon and Michael Smart, who are both in Canada. All right, so let me start with a little bit of introduction or where it's all coming from. It is coming from basically thinking about how to tax businesses, and from thinking about just realizing that there are different ways of taxing businesses. So for people that work on like profit shifting and multinationals, that's not very interesting because they think mostly about like corporate tax. But most businesses don't have to be taxed under a corporate tax. You actually have choices. You can tax business income using individual income taxation rather than corporate taxation. And pretty much every country draws a line somewhere and defines who is subject to one type of treatment versus the other type of a treatment. So just to be more careful about this, basically you can think about broadly speaking two different types of approaches. What I call here is the way I call them here is accrual approach and realization approach. Accrual approach is also what's known or what's referred to nowadays as pass-through taxation. So basically the idea there is that we have individual income taxation, And business incomes are just another type of an income. So we are going to tax business incomes as incomes of individuals. And pretty much every country does a little bit of it. So usually very small businesses, like sole proprietors, if you want to call them businesses, are taxed in that way. You don't think about a sole proprietor as a separate entity that you would, where you would impose the tax on the entity level, but you are thinking about the income of a sole proprietor as income of a person, and if that person has other forms of income, then you would aggregate all of these things together, and that's the base for individual income taxation. You can do the same thing for bigger businesses. Step up, like I could think about partnership, like a couple, two people or a few people getting together and setting up business activity together. And then usually there are it's a contract and income is allocated between them somehow, and that income is the income of individuals. And you can do it for much bigger firms, and some countries do it that way. So the US in particular, but I'll show you in a second that it's not just the US. In the US there is something called the S corporation, which is corporate structure. It's just a corporation that can elect a treatment as a pass-through entity. And then what's happening is that you take income from that pass-through entity allocated to shareholders in proportion to their ownership shares, and then every shareholder is reporting that as their personal income, and that's the form of taxation. There is no corporate tax liability. All of the income is sort of passing through to individuals. Why would you want to do something like this rather than corporate taxation? So there are some advantages to it. And actually, if I was thinking like as a theorist who doesn't know anything about the real world, I would tell you that this is actually the right approach. And this is the right approach because what that approach gives me is a comprehensive full picture of the income of a particular person in a particular year. So if I want to think about redistribution, progressive tax system, and so on, then what I'm getting here is an accurate measure of income of individuals, of all of the individuals that accounts for both business and other types of income at the same time. So then I can start implementing a progressive income tax system and so on. If you look at sort of the US way of doing this, but also in other countries, there are some rules who can do things that way. I think those rules are also kind of instructive. The rules are primarily about, well, one is about not changing treatment too often. Let's put that aside. But another one is about not having too many shareholders. Like there is a maximum number of shareholders that you can have in order to elect this type of a treatment. Why is that? I mean, basically, if you think about large publicly traded companies, maybe this is not a very, very feasible approach to implement it in that way. Although you could still imagine doing something along these lines, but you may think that administrative and there are difficulties in doing it for firms with very, very large number of shareholders. So that's one. The other one is that, at least on the books, because they've been erased, kind of really they are not that effective anymore. At least on the books, the intention of this was that shareholders should be individuals residing in a given country. So not foreigners, not institutions. Basically, the idea is that you should be able to capture that income as individual income. So this should be people who are subject to individual income taxation. So that means that that if you are going to have in particular, taxing foreigners is difficult. If you have institutions tax-exempt, in particular tax-exempt entities that are shareholders of companies, then you would you would be allowing them to escape tax, or you would be allowing large parts of profits to escape taxation. So this is one approach. And to me, the question is not like, do you use this approach or corporate taxation? To me, the question is like, how do you draw a line between one and the other? Because everybody actually draws some line. And everybody uses some combination of these two things, even if you usually don't think about it in that way. So the other approach is a two-tier system with corporate taxation and then some recognition of that of income from corporations on the individual side. So that's kind of familiar. You have a tax on the business level, on the corporation level, and if you think about this, many arguments for these things also relate to progressivity. Like we want to tax corporations because wealthy people own corporations, but there is a bit of a tension here because corporate tax does not depend on who owns the corporation. Like if it's like a million people with retirement accounts and kind of very dispersed ownership, or if it's a corporation that's controlled by one person, the corporate tax liability is exactly the same. So that's, to me, like the argument that corporate taxes are about like a way of implementing progressivity, period, that actually doesn't hold that much water. It may hold water once you start thinking about problems with individual income taxation. But like on its own, this is actually the kind of peculiar way of achieving redistributive objectives. What links it with individual income taxation and kind of redistribution and progressivity is that income from corporations usually is subject to individual income taxation. Exactly how and what the rules are may vary depending on the country and the period, but usually dividends and capital gains are subject to individual income taxation. Now, I call it a realization approach because corporate tax liability, I guess if you put aside some issues about like multinationals and so on, but basically you are trying to tax annual profits on an ongoing basis. But if you think about how does that show up on the individual side, well, that's a decision because income shows up if dividends are paid, or income shows up if capital gains are realized. So in each case, this is a decision either of an individual directly, whether you want to sell your shares, or it's a decision of the corporation. And in particular, if you think about closely held corporations, that's probably the same person that can sell shares. The same person makes decisions about whether to realize dividends or not. So there is this realization decision. There is a decision when to recognize the income, and that may create issues. All right. So who is doing what? So this is. This is from a report that in the U.S. Joint Committee on Taxation did at some point. And like basically what I want to take from this is that there is a lot of variation, and there are some, countries do very different things. So so this is, take all of the business incomes in the economy. What share of those incomes is subject to the corporate tax? What share of this income is subject to this pass-through treatment? And so in some countries like Australia or Canada or well, these are the two highest ones, but UK, this is a majority of profits are subject to corporate taxation. In some other countries like the US, but also Germany and Japan, so big economies, it's actually the other way around. So pass-through taxation is a very big component of this. That may be surprising, but because we tend to think about like large corporations and that's and their profits, and those are usually, well, if they are publicly traded, they will be subject almost always to corporate taxation. But if they are closely held, family businesses of different types and so on, I mean, these rules vary across countries, and actually I'll show you over time. And in many cases, they may be subject to the pass-through treatment. In the US, in particular, there are a lot of large firms, closely held private firms, who are subject to pass-through taxation. In Germany too. Right, so this is basically the same thing, but we kind of extrapolated or constructed it for a few countries over time. So we had 3 of those. Well, we had all of those on the in the previous table, but if you look toward the end of the period, you get UK, Canada, and Australia with high reliance on entity-level tax, so high reliance on corporate taxation, and you get the US with much lower reliance on corporate taxation. So that's at a point in time toward the end of the period on this graph. That's what was in the table. But the other thing that's kind of interesting here is, to me, is if you look at the US. Then there has been a massive change over time. If you go back like 40, 50 years, in the US relied on corporate taxation, and then nowadays it sort of moved to a pass-through regime in a much more extensive way than it used to be the case. So some of it happened through changes in taxation. Some of this happened through legal changes of other sorts. So the taxation aspect of it is, I mean, there are incentives to be in one versus the other. On one side, you are thinking about corporate tax, and then future dividend and capital gains taxes. On the other side, you are thinking about individual income taxation. So the relationship of these tax rates, and it's not necessarily like extremely straightforward comparison, because when you are thinking about dividends and capital gains, you are thinking about future taxes on dividends and capital gains, not necessarily today's tax rates. And you are thinking about like your future payout strategy and how long you are going to hold on, like how long you are going to keep money within a business and when you are going to pay it out. And maybe you should be actually thinking about what happens with when you die while owning a business and like things like this. But like general comparison is that like on one side you have these taxes that apply to corporate tax and whatever follows from it. On the other hand, you are thinking about individual income taxes. If you have a choice, then like you would make a comparison, like which one makes more sense for me. And in the US, that calculation kind of flipped in the 1980s from pretty clear advantage of corporate taxation to an advantage of individual income taxation. So that's one part of what happened. The other part of, and in the US you can select if you meet the criteria, so you can actually check the box. The other thing that happened is kind of development of new legal organizational forms. So if I take Norwegian case, and actually the case in many other countries, there is kind of a presumption that if you are a corporation, then you are going to be subject to a corporate tax. So the way not to be subject to a corporate tax would be to have like some other organizational form, but then it becomes kind of difficult to have limited liability and kind of other advantages that come with a corporate form. In the US, what happened over time was the development of something called limited liability companies, which are basically partnerships, very flexible things that give you limited liability, but also qualified for that treatment. And that was kind of a trend in organizational forms. Like a lot of new firms were created as those types of things. So, there may be both like tax and non-tax elements to all of this. All right. That takes me to what we are actually looking at in this paper. So we are basically interested in implications of incorporation. And for us, primarily, like we are thinking about incorporation as a tax event. When you are a corporation, then you are going to be subject to corporate treatment with these realization aspects, meaning, in particular, what's called deferral. I can defer when my income is going to show up on individual tax returns. And the alternative to that is individual income taxation. In Canadian context, basically, you incorporate, you are subject to the corporate tax with all those implications. If you want to be kind of a pass-through entity, then you are not, well, you are not a corporation, you don't have limited liability. So there are additional things that come with incorporation, like limited liability and some additional regulations. So I'm not going to talk about them. I don't think they are super important in our context, but like, if you want to complain about something, like we are looking at the effect of incorporation, and I'm going to talk about like tax consequences of it, but there are some other things that that come with incorporation. All right. So let me tell you what it is that we are actually doing. We are looking at, I've already said, we are going to look at doctors in Canada. And we are going to look at the effect of introducing an option, a possibility for them to incorporate. So before, they basically were individuals, or they were unincorporated businesses. Afterwards, they can be a corporation. They have to make that decision, but medical companies could not be corporations beforehand, and they can be corporations afterwards. And you'll see that they take it up. The empirical objective is to understand like behavioral responses to that option, I talked about pass-through versus corporate taxation, but there's also like another direction that's behind what we are doing and where we are coming from. I've known Michael Smart for a very long time, and we've been talking about something like this for a long time. So basically, that direction is from the literature on taxable income elasticity. That was a big deal for a while. Now it's kind of dormant, but I still think it's very interesting. And that literature basically asks how taxable income responds to changes in taxation. But once you start thinking about businesses or people that own businesses, where these deferral opportunities exist, then you kind of quickly realize it's more complicated. So one thing is, well, they may be changing their organizational form. They may be switching from being subject to individual income tax to the corporate tax. And if they are corporations, then there will be dividends that will come in the future and capital gains that come in the future and like all of those things. So there isn't really like, there is a tax reform or there are tax changes. Can I think about this as sort of annual decisions where I'm studying the effect on income like year after year, which is effectively what a lot of papers on responsiveness to taxation do. And I would argue that like in these types of contexts, you can't, because especially if there is organizational form decisions, but also if there are just changes in within say a corporation, how much income I'm going to defer, then to fully understand what exactly is happening, I need to know what happens this year, next year, what happens in the future as people are starting to pull money out from those companies, like what happens to future payout strategies and so on, and also what's happening on the both on the individual and corporate side, on both sides of this. So we have pretty good data, although you will see not Norwegian data. Or I'll mention some things. So the important things for us is that we can link individuals and businesses. So we can look both what happens on the individual side and on the business side. We can link families. So Canada has individual taxation, meaning that there are actually incentives to shift income within a family. So and corporations kind of a mechanism for doing some of those things. So it's important to actually be able to do that. And we don't have infinite follow-up, but we have 12 years, which is still not enough to see the rest of people's lives, but it at least allows us to look at responses kind of as they develop over time. I'll probably manage to say something about heterogeneity by age groups, and there is more that we are doing on this, but that's kind of our way of actually trying to think about kind of life cycle. All right, so I need to tell you a little bit about businesses of Canadian doctors and like how that operates. So I guess there is one way of interpreting of what we are doing is as this is my first health economics paper, although it's not really. But like in general, you can think that a doctor could be an employee of a hospital or a clinic, or it could be an unincorporated business, or it could be, or basically, a person with professional income, and that's able to deduct some costs, or it could be a corporate business owner. And before the reform, only the first two of these options were feasible, and after the reform, all three are feasible. Our understanding of the way it works in Canada is that actually employees are not that common. So doctors are usually not employees. They are usually unincorporated businesses or professionals. Before the reform, they were unincorporated businesses, meaning that they will bill insurance as themselves, rather than being paid salary by the hospital. Now they will still work in a hospital or or somewhere else, but kind of from the tax point of view, they sort of look like sole proprietor. And after the reform, they will just bill as a corporation. And they can still do it within exactly the same setting. There is a restriction on that medical companies must be owned by physicians. And basically there was a legal restriction. They could, like these types of companies could not be incorporated. Like if you go back long in the past, and there may be good reasons, and actually I'll show you. Maybe that wasn't such a bad idea, with caveats. And then over time, those restrictions have been lifted, and doctors were actually allowed to incorporate. And Canada is a federal country, so different provinces have did it at different points in time. Now. We are going to look at Ontario, and we are going to look at 2006 as an event. By 2006, most of the provinces have already implemented this thing, and actually the ones that implemented it did it before start of our data. So we are going to use those that implemented that already allowed doctors to incorporate as our control group, which is a bit of an issue because they have been treated already, rather, so it's not a never treated group. There are two provinces, Quebec and Alberta, who did the same thing, but later on. In principle, we think we can study it, but we have problems actually understanding exactly what happened there, and the problems, I think, are kind of similar to our problems with understanding what happened in Ontario, which we now understand. So in Ontario, there was the reform that there is a bill that said you can incorporate in 2001, but yet we are going to use 2006. In 2006, there was another bill that said you can make your spouses shareholders in a medical company, or family members can become shareholders. So, like, if you went by this, you would say like 2006 reform is just an extension allowing spouses to be shareholders. But I'll show you that. Incorporation really takes off in 2006, not in 2001. And we actually spent some time talking to lawyers and accountants who basically told us, yes, like in principle, you could have done it, and some people have done it before 2006, but really there was no guidance, and it was not clear exactly how to do it, and regulations that about this, and opinions of the Canadian Medical Association, or however it's called, about like implications of this. Like this all really started in 2006. So for us, the reform is in 2006. Now, there are some strange things about this setting. So this is doctors in Canada, one particular industry. Actually, it's doctors and physicians and dentists. For now, we are grouping them together. There are reasons to think about them separately. Physicians, medical professionals are a bigger part of this group. And they are dealing with a single-payer healthcare system. So, and Canada is actually very, very kind of toward the extreme of how that works. So most of the healthcare is really paid for by this public system. So the payment side or prices for these services are not like this is not the same market as many other markets. It's very special in this sense. On the other hand, doctors are private, and they can make their own decisions. In particular, they can make their decisions about how much to invest, and especially how much they work. So we are thinking about like that side of things as being kind of typical for kind of self-employed individuals. So one reason to look at dentists separately is because they are not subject to the same rules. So maybe that's interesting. The other reason is that businesses of dentists empirically look actually a bit different than businesses of doctors, especially in Canada. So I'll show you later. These are literally, almost literally like, this is a person. I mean, they have some employees, but the average number of employees before the reform is 0.6. And that 0.6 may include the spouse. So they don't have a lot of employees. They also don't own a lot of equipment. So these are just professionals. In particular, they will be retaining a lot of earnings within their businesses, but selling this type of a business is really not very straightforward because that's invested somehow. So, like, who's going to buy my retirement account? That's tied into, like, a corporate entity. So there isn't really a very active market for selling these types of businesses. Businesses of dentists are potentially different because they are more likely real businesses. They own a little bit more equipment. They also tend to have customers that keep coming back to them, so you can actually sell the business and your customer base. So there are reasons to separate it, but we haven't done it yet. Now, in terms of tax incentives, the personal tax rate, say, just before the reform, it changed, like these things changed a bit over time, but not in massive ways. The personal tax rate before the reform was 46%, the top personal income tax rate. And doctors are, not all of the doctors are in this top bracket, but really, like, after a few years, as their incomes over time increase, like, they end up in the top bracket. So that's kind of, the relevant rate. There is if they are a corporation, there is a special rate, low rate for small corporations. That's 17%. So that looks like a big differential, 46 versus 17%. Nominally, they have full integration, meaning that if all that you were doing was have a corporation, it has profits, you are paying all of the profits immediately as dividends, then the dividend tax rate would be adjusted, is kind of set up so that your effective tax rate is the 46%, the same as personal income tax rate. But I'm saying nominally with full integration because in practice, and they kind of, toward the end of the period, they kind of figure out some of these things and tighten those rules. If you keep saving within a firm, investing within a firm, then that adjustment is no longer like this. So we can basically save within a firm at better interest rate or lower tax rate than outside of the firm. So there is a potential for deferral here. But like the benefit is from keeping money within a firm and investing within a firm rather than just being a corporation and paying out immediately. All right. I'll skip this one. I'll show this one. So this is just to say how to frame how you should be thinking about this, or to guide you in the direction that we want to think about this. And this is from the lobbying organization that was like protesting some changes in capital gains taxation later on. What do they say about these medical corporations? Why do you have them? So they kind of dismiss like tax benefits from this. But interestingly, what they highlight is that this is a saving vehicle. It's a way to save for retirement. It's the way to save for like emergencies and things like this. Now, they don't tell you why you couldn't do that type of saving outside of a corporation with money that you get, that you pay out to yourself. Because of course you could. But what's kind of interesting to us here is that like they explicitly tell you, well, a firm is a saving account, among other things, but it's also a saving account. All right, so this is actually not from administrative data. It's from data that we scraped that actually tells us when they incorporated. Like this is what I was talking about. This is a share of doctors who are incorporated, and it like took off after 2005. Okay, not a lot of interesting things here, other than just saying that doctors across many different specialties do it, so there isn't like a particular pattern. I will not have enough time to talk about all of this. Different cohorts adopted different times. I'll come back to this. One thing that I want to do before actually showing you empirical work is to tell you a little bit about what you might expect. So actually do a teeny bit of theoretical framework that's extremely simplified. And also kind of highlights how we are thinking about this. So we are talking about, you could say we are talking about firms, but I'm going to start by writing a utility of a person, because it's a person. It's a doctor that's making decisions about how to organize his or her life. Professional aspects of it, but really not just professional. It's like potentially savings. So it's a person that's maximizing utility, and there is X is consumption and L is labor supply, standard thing, and you can and you should complicate it, but I'm going to simplify in a major way. So I'm going to basically think about two regimes. One regime when you are incorporated, and the other regime when you are not where you are unincorporated. The simplification is that if you are in a corporate regime, all of your saving happens within a corporation. You don't have any savings outside. And if you are in the unincorporated regime, then all of your saving is outside of a corporation. That's probably not true. Like people who have corporations have some additional saving, but the main thing I want to get out of this is basically, the types of things that could happen rather than like full description. All right. So let's start with unincorporated individuals. How does their budget constraint look like period by period? I mean, you could write it as assets today are equal to assets yesterday plus some rate of return plus income minus consumption. So this is exactly what it is. It's just that I put consumption on the left-hand side. So consumption is this change in assets where assets grow at some rate RP. That's a rate of return that you get in on your investments on the personal side. So taxable, subject to potentially subject to income taxation if you are getting dividends from investments in listed companies, or if you are realizing capital gains or whatever. So I'm going to think about RP as relatively big, relatively small. That rate of return is subject to taxation on the personal side, so kind of relatively low. And then you have your income. What is your income? It's what you get out of your work. And I'm pretending that it's a firm, so I wrote it as f of L, so it's production function. You can also notice that I didn't put any capital there. That's because there won't be that much capital. And that's subject to personal income taxation. All right, so that's one. What happens if I'm incorporated? When I'm incorporated, it's actually almost the same thing. Like if you look within these square brackets, the structure is the same. I'm accumulating assets, they grow at some rate of return, but now it's the rate of return within a corporation. And the expectation here is that this is actually preferential rate of return, higher rate of return. And then if I have a business and it's like it has profits, and then 1 minus tau C is what I keep after corporate taxes. So it's the same structure. It's just the there's corporate tax rate rather than personal tax rate. And then if I want to consume, then I have to pay out dividends. So there's dividend taxation, and that's where 1 minus tau D comes from. All right. So you can write the standard Euler equation here, and it will tell you that I'm going to trade off consumption today versus consumption tomorrow, and it's very, very standard with this rate of return. And in the two regimes, there are two different rates of return. There are different rates of return. So that means that I would expect that consumption profiles will be different depending on which regime I'm in. So basically, in the corporate regime, I should be saving and consuming later, and in the personal regime, I should be consuming earlier or kind of have flatter consumption profile. Kind of an interesting observation here is that this is independent of dividend taxation, because I'm saving within a firm and I will have to pay taxes either today or tomorrow. So this is really analogous to something called new view or trapped equity view in capital income taxes, even though this is about just this business form, and these people are working and saving without any additional investments. All right. On the labor supply side, again, the same type of thing. You can write down the first order conditions. Well, it will be this utility of labor and marginal product of labor related to marginal utility of consumption and relevant tax rates. So there is personal tax rate on one side and a combination of corporate and dividend taxation on the other side. If you believe full integration, then these tax rates, personal tax rate and this product of the two rates on the corporate side are identical. So there is no difference in the tax rates. But we've just argued that consumption profiles are different. So U prime in the two regimes is not the same. So there is these incentives for consumption and saving translate also into incentives for labor supply. To put it differently, basically what the incentives here are that you get this saving vehicle that allows you to save at a better rate of return. So you should be saving. How do you save? Well, you have to generate some income. How do you generate that income? You generate it by working. So you should be working when you are young and save, and then presumably work less and consume in the future. So you should retire earlier. So the real incentives go in that direction. Accelerate labor supply, work earlier, and potentially retire later. Right. The reason I'm talking about this is that we are going to see something like this, which is something that surprised us. All right. Quickly on the data. Individual, business, family data covering 2001 to 2017, both incorporated and unincorporated businesses. That's very important to us because it means that basically we are identifying doctors by ownership of unincorporated business before the reform. And there are some limitations related to it, but I'll skip that. It's a keynote talk, so you cannot push me on this. I'm going to just show you one empirical strategy, which is a triple difference strategy, where we are comparing doctors in Ontario to doctors in other provinces, except Quebec and Alberta. And we are comparing all of them, or province by province, to people who own businesses in industries that have very similar pre-reform incorporation rates. Why are we doing something like this? We are doing something like this because for some outcomes, it's kind of important. Because if doctors in Ontario didn't have corporations before 2006, that means they didn't have retained earnings, while control group had retained earnings that may have been like basically trending with their life cycle. So we are getting these kinds of deviations. So that allows us to kind of deal with things like this, and we do some matching to this. The rest of it, and it is showing me that I have 5 minutes, but I only have graphs from this point on that I'll go through very quickly. So this is the first stage. The effect on incorporation happens in 2005, kind of at the time of this reform, you start seeing a lot of businesses, a lot of these doctors incorporating. they usually own more than one business. I'll skip some of this, but like ownership of multiple businesses, holding companies, things like this, a set of interesting topics there. What happens to their income? So this is the definition of income that kind of a comprehensive definition of income that takes the two spouses, if people are married, takes income on the individual side, takes profits on the business side, adds up those things kind of to avoid double counting because dividends could kind of complicate things. All right. So this is the background of this is that we totally expected we were going to write a tax paper about tax income shifting and tax avoidance. That's not the only thing that we got, and that's this graph. So what this graph shows is that there is an increase. What it looks like there is an increase in income, kind of happening right after the reform. So again, individual and business side taken together, but it seems like they are actually doing more, and it's actually not that small. So this is, you see the pre-reform mean. So that's like about 10% increase of income. And then after a while, it starts declining. Now, I didn't prove it to you, but this is why I had this theory. It is consistent with this. Now, that's also what we are doing more work on. It is consistent with this kind of acceleration of work, and then after a while, starting to potentially work less. This is constructed by adding up different things, so we can separate it into those components. So the blue line here is what you had before, and then the other lines are personal and firm side of things. So personal income starts declining because they are setting up corporations and putting money in firms. The business side increases, and then after a while, that's where you see the decline. Within a family, this is the doctor and the spouse. To my surprise, actually, only 15% of doctors are married to other doctors, so most spouses are not doctors. So personal income of the doctor goes down. The income of the spouse actually goes a little bit up, and I'm not sure if shading can be seen very well, but it's a little bit statistically significant. So it looks like some shifting within a family. Skip some of these things. Are they paying dividends? Well, they should not be, or at least not too much. Because the whole point of doing these things is to retain. And it takes them a few years to start paying some dividends. I mean, these people are aging and so on, so like after a while, they should be paying dividends. The magnitude of these numbers, this is smaller than the profits that they keep in the business. But after a while, they start paying some dividends. But if they are not paying out all of their profits as dividends, then they are probably retaining earnings. And that's what this graph shows. The retained earnings start growing quite a bit. And after a while, what you get here is something of the order of $150,000 to $200,000. And that's half or more of their annual income. So they accumulate within those firms. This is not the best even static graph that I've ever seen, but the key thing here is the scale. These are tiny numbers. This is like less than $1,000, so there is really nothing that's happening on the capital gains side. Are they doing more within those firms? They employ a little bit more people. This is what I said, from 0.6 to 0.9. Including the spouse. And this graph starts in 2005 because our unincorporated businesses data only starts in 2005, so we cannot do it differently. And to see employees, like we actually had to use this. So they employ more. Maybe some of it is real, but a lot of it is just the spouse, potentially a way of shifting income. This one looks a little bit more real. So equipment and machinery. They are actually, it seems that they are actually doing investing a bit more. The scale of it is tiny because they own like $10,000 of debt after a while, given their annual incomes of $300,000. But it is pointing in the same direction. Can do some other things. You can look at revenue rather than business income. I want to show some things about taxes before I get kicked out. All right, so what happens to taxes? They are actually doing more, and the effect on taxes is initially it's slightly positive, then after a while, the taxes that they pay actually go down. So if you want like net present value, they are probably saving quite a bit of taxes, but it's kind of, there's a dynamic effect to it. And that consists of this mix of personal and business side. Personal taxes, what you get from individual income tax data goes down. What you get from on the corporate side goes up. The average tax rate actually takes a while to decline. And then you can start looking at these things by cohorts, and different cohorts respond in different ways. The big response initially is by people who have, who are in their 40s and 50s, so not by the youngest and not by the oldest people, although younger and older people after a while also start catching up. I would argue that's also consistent with the way I was trying to frame it, because really these things make sense when you start saving. And the doctor that's like fresh out of medical school and starting to work, they probably have some debt and so on, so they are not saving yet. They should set up this corporation after a while when they are in a position to save. And then this is the final one I'm going to show is if you look at how their income looks like. That's actually where you get a little bit of additional support for this labor supply story. The decline is happening. There's an increase and then decline, but the decline is really for these older cohorts. For the young people who, like 12 years after, are maybe approaching their 50s, like you don't see it yet. For older cohorts, you start seeing those declines, so kind of potentially corresponding to maybe not necessarily retirement, but kind of slowing down and to benefit from these things. All right, so I have a bunch of other things and then conclusions. The main thing that I hope you'll take from it, because this is work in progress, is that when we want to think about businesses, especially closely held businesses, like you want to think about owners and firms together, because those interactions are important for like actually understanding the incentives here and what they are doing both on the business side and on the individual side.